Imagine waking up tomorrow to find your mortgage payment has doubled. Businesses stop hiring, the stock market plummets, and home prices drop. Suddenly, everyone is looking for answers from a single institution, the Federal Reserve. It is an unelected body, often misunderstood by the public, yet it functions as the central engine of the American financial system. To understand its power, we have to look back more than a century. Before the Federal Reserve existed, America's banking system operated without any central stabilizing force. In that era, banks failed regularly. When rumors of instability spread, people rushed to the teller windows in a panic, desperate to withdraw their savings before the vault ran dry. The most severe wake-up call came in 1907. A banking panic swept the nation, wiping out businesses and leaving banks across the country without enough cash to meet the demands of their depositors. Without a central authority to step in, financial freedom frequently dissolved into financial terror, leaving the public with zero confidence in the system. During the 1907 crisis, the system only survived because private banker J.P. Morgan used his own wealth and personal influence to organize a rescue and stop the collapse. This left lawmakers with a chilling realization. If a similar crisis hit and there was no billionaire willing or able to save the economy, the entire country would be doomed. To fill that vacuum, Congress created the Federal Reserve in 1913. Its mandate was to provide the stability that a private individual could not. It was established not to control the economy, but to protect it, tasked with maintaining stable prices and supporting full employment to prevent the next great panic. While the Federal Reserve is the nation's central bank, its primary job isn't the physical printing of cash. Instead, the Fed manages the economy by controlling the conditions under which money flows. Its most influential tool for this is the setting of interest rates. Think of it like an accelerator. When the Fed lowers interest rates, borrowing becomes cheaper. Businesses take out loans to expand, consumers spend more on homes and cars, and the economy grows. But if the economy accelerates too quickly, inflation begins to rise. This reduces the purchasing power of your money, meaning your savings buy less than they did before. To stop this, the Fed hits the brakes. By raising interest rates, they make borrowing expensive. This discourages spending and slows down growth until inflation is back under control. By adjusting these borrowing costs, the Fed can influence the financial behavior of hundreds of millions of people without ever issuing a single direct command. In extreme crises, simply adjusting interest rates isn't enough to prevent a recession. In those moments, the Fed turns to a more drastic measure, quantitative easing. The Fed digitally creates money to buy government bonds and other financial assets. This injects emergency cash directly into the system, ensuring banks have enough liquidity to keep lending. This unprecedented intervention was the primary tool used to fight the 2008 financial crisis and the sudden economic freeze caused by the COVID-19 pandemic. While these actions prevented a total collapse, they created significant trade-offs. By aggressively buying assets, the Fed drove up the value of stocks and real estate. This benefited those who already owned those assets, while making it harder for others to enter the market, an outcome that critics argue has widened the gap between the wealthy and everyone else. The Fed's influence extends far beyond the United States. Because the US dollar is the primary reserve currency for the world, the Fed's domestic policy effectively sets the pace for the global economy. When the Fed raises rates, global investors often move their money into US assets. This can cause other currencies to weaken and make it much more expensive for emerging markets to pay back their debts. Despite this global reach, the Fed's power is specific. It does not control government spending or national policy. Those decisions remain the responsibility of the President and Congress. The Fed's work is a constant balancing act, known as the dual mandate. It must try to keep inflation low while simultaneously fostering a job market strong enough to sustain the population. These goals often pull in opposite directions. Fighting inflation by raising rates risks higher unemployment, while keeping rates low to encourage hiring can cause prices to spiral. Every choice the Fed makes, from the interest on your savings to the price of your next loan, determines the financial boundaries of your life. Understanding the Federal Reserve is the first step towards seeing how the modern world actually works.